So welcome to the first accounting tutorial. This tutorial is going to be on the accounting equation and we're going to look at double entry bookkeeping. Firstly, we're just going to look at some definitions. So an asset is owned by its owner and is worth something to its owner, or it's any right which is of economic value to its owner. And there are two types of assets. So firstly, you have fixed assets. So these are assets that the business will hold for more than 12 months. And they're acquired by the business with the intention of retaining them within the business to help generate profit. So examples of fixed assets would be tangible assets such as land and buildings, equipment. You can also have motor vehicles and machinery. And you would have investment properties would be fixed assets. So these would be properties held by the business that they want to generate rental income from, or that they're holding on to sell at a profit at a later date. You can also have intangible assets. So this would be items such as goodwill or research and development investment. And you can also have financial assets. So this would be shares in other companies held by the business itself. You then have current assets. So these are assets held by the business for less than 12 months. And they're assets which arise from day-to-day trading activities. And they're cash or assets that the business intends to turn into cash. So a prime example would be your stock or your inventory. Naturally, the business is going to want to turn this into cash within 12 months. You can have debtors, so this would be amounts that's owed to the business, so they'll want to generate that into cash within 12 months. You have the cash or bank that's owned by the business, and you also have prepaid expenses. A definition of a liability would be the source of funds from outsiders, or amounts owed to people or firms outside of the business. Liabilities, naturally there are two different types as well. So you have creditors falling due after more than 1 year, so more than 12 months. And this could be long-term loans or debentures. So the business might not need to repay them for another 10 to 15 or 20 years even. And then you have creditors falling due within 1 year. So creditors that the business needs to pay within 12 months. So you can have creditors such as trade creditors. You could have short-term borrowings from banks. Your taxation expense will usually need to be paid within 12 months, and you can also have accrued expenses. Ownership interest. This is often referred to as capital or capital employed, equity or shareholders funds. So it's the liability of the entity to the owners of the entity. So basically it's money that the business actually owes to the owners themselves. Definitions of ownership interest would be the owner's claim on the business, or the assets less the liabilities of the business, which is also our accounting equation. Now we'll just look at our accounting equation and we'll just break it down a little bit. So basically our accounting equation is our assets equal our liabilities. But our liabilities can be broken up into liabilities such as our long-term creditors, so loans and debentures, and short-term creditors, so taxation, other creditors, short-term borrowings, and also ownership interest, because the business owes the owners money, so it's a liability to the business. And if we just rejig this equation, we can see that our assets minus our liabilities needs to equal our ownership interest. If we just take a small example here, John decides to set up a taxi business. So he uses 10,000 euro savings and borrows 15,000 euro from the bank to buy a car for 25,000 euro. So the assets, naturally, is going to be the car for 25,000 euro that he needs to run his taxi business. Liabilities, he borrowed 15,000 euro from the bank, so the business is going to have to pay that back. And the capital is John's investment of 10,000 euro worth of savings. So if we put this in terms of our accounting equation of assets equals liabilities plus ownership interest, we'll have our 25,000 euro car is equal to our 15,000 euro loan plus our 10,000 euro savings investment. Now businesses can have profits and gains and losses. So profits or gains are increases in ownership interest not resulting from contributions from owners. And losses are decreases in ownership interest not resulting from distribution to owners. So basically they arise not from any change in the capital of the business. We'll just look at a small example here. So we have Alison, and she invests 10,000 euro in cash in a new business, and she uses some of this money to purchase a stock of 100 pair of shoes for 8,000 euro, and she sells 50 pairs of shoes for 7,000 euro in cash. So initially, in terms of our accounting equation, Alison's investments will look like this. Our €10,000 is going to belong to the entity in forms of a bank of €10,000, which is an asset. And then the business has a liability of capital of €10,000, which it owes to Alison. So Alison then buys 100 pair of shoes for €8,000. So naturally, our bank account will decrease by €8,000 to €2,000. But we now also have an additional asset of inventory of 100 pairs of shoes, and our capital investment remains unchanged. Now when Alison sells 50 pairs of shoes for €7,000, firstly our bank account is going to increase by €7,000, so we go from 2 to 9,000. And our shoe inventory is going to go down from 8,000 to 4,000 euro. But as we can see, our equation is out of balance. And the reason for this is because Alison made a profit of 3,000 euro. So as we can see at the end of all these transactions, with regard to the entity has two assets. It has a bank balance of 9,000 euro and it has inventory worth 4,000 euro of shoes. And with regard to our ownership interest, we have a profit of 3,000 euro that's resulted from the sale of shoes. And we have our capital investment of 10,000 euro. If we look at a slightly more complex example, we have Brian. So Brian inherits a boat worth 20,000 euro and decides to start a boat hire business. So in the first month, 2,000 euro of hire fees are received in cash. And at the end of the first month, Brian owes 500 euro in berthing fees that are still unpaid. And lastly, Brian decides to take 750 euro from the business as a capital withdrawal. So firstly, Brian's investment, he invests the boat. So the business now has an asset of 20,000 euro of a boat. And there's also capital of 20,000 euro. So the business owes Brian 20,000 euro. So in the first month, he makes 2,000 euro in hire fees from the boat. So our bank account is going to increase by 2,000 euros. We have an additional asset. But we also have a profit. So our ownership interest is going to increase. Brian then has berthing fees, which he doesn't pay. So naturally, because they're unpaid, they're a liability to the business. So as you can see, our assets of the boat and the bank remain unchanged. We now have a liability of 500 euro, and our profit has decreased by 500 euro. And our equation is still in balance because our assets minus our liabilities is equal to our ownership interest. Then Brian decides he's going to take 750 euro out of his capital investment that's owed to him by the business. So firstly, we can see our bank account is going to decrease by 750 euro. So we now have a balance of 1,250. And our capital is down to 19,250 euro. So the business actually owes him less money. And after all these transactions, we can see with regards to the entity, it has assets and liabilities. So it has assets of a boat and a bank account. And it also has fees due, which is a liability. And then with regard to ownership interest, we have a profit, and we have the capital that the business still remains to pay to Brian. Just a quick recap there on our accounting equation. So we have assets minus liabilities is going to equal our capital, plus our revenue, minus the expenses, and minus our drawings. And if we look at these in terms of debits and credits, we'll see that debit transactions, so we have assets, we have expenses, and we have drawings. And on the credit side, we have capital, and we have revenue, and we have liabilities. And it's important to note that with regard to our accounting equation, the sum of all our debits must equal the sum of all our credits, otherwise our equation won't be in balance. Now we're going to look at preparing a set of accounts. So firstly, we need to record all transactions, and then we need to extract a list of balances at the end of the period called a trial balance. And finally, we prepare a profit and loss account and balance sheet from the list of balances. So how do we record our transactions? We use T accounts with debit and credit entries for individual accounts. And if we just look at these individual accounts, with regard to our assets, we can see that an increase in an asset will be a debit, while a decrease in an asset will be a credit. So for instance, if I bought a motor vehicle for my business, then I will debit my asset account, Or if I sold a motor vehicle, then I would be crediting my asset account. Liabilities. So an increase in a liability will be a credit, while a decrease in a liability will be a debit. Revenue. So if there's an increase in revenue, it will be a credit, and if there's a decrease in revenue, there will be a debit. And expenses. So if we increase an expense, it's going to be a debit, and if we decrease an expense, it will be a credit. So if we just look at the double entries, we'll see that with regard to increases, we'll debit an asset, credit a liability, debit an expense, and credit a gain. And then obviously it's going to be the opposite for decreases. So with regard to decreases, we would have a credit for an asset, a debit for a liability, a credit for an expense, and we would debit a loss. And it's kind of important that you just need to learn the bank as its own. So if you have an increase in bank or in cash, it's going to be a debit, and if you have a decrease, it's going to be a credit. Now we're just going to look at some tutorial questions. So we're going to look at Michael Green and we're going to look at Kate Combay. And thank you for listening to the first accounting tutorial.